When you hear the name Warren Buffett, you probably instantly think of Omaha, the vast holding company Berkshire Hathaway, and billions of dollars in the bank. The image that comes to mind is that of the Oracle of Omaha, a folksy, genial billionaire dispensing simple, timeless investment wisdom. But what if I told you the true story of how he made his first $1 million is almost entirely misunderstood? His initial fortune was not built on the simple, passive, buy and hold advice he champions today. It wasn't about finding a single revolutionary stock. In fact, if you tried to replicate his exact path to that first million, you might find yourself doing things that sound less like polite investing and more like aggressive corporate raiding and financial activism. The reality is that the foundation of the Oracle of Omaha's eventual empire was forged in 4 surprising, often forgotten ventures. A calculated, hands-on blend of youthful hustle, deep value analysis, market arbitrage, and aggressive old-school corporate activism. Stick around because we're peeling back the layers on the true, often untold story of how a young, hungry Warren Buffett earned his first million, and why these early unconventional lessons were absolutely crucial to the sprawling, successful empire he built thereafter. To understand the leap to $1 million, we have to start earlier, examining the source of his initial seed capital and the formation of his early business mindset. Buffett was never a typical kid waiting for an allowance. His entrepreneurial drive was evident almost immediately. By the age of 6, he was already engaging in rudimentary retail by selling chewing gum door to door. By the time he was a teenager, his financial operations were complex enough that he was filing a tax return. His first significant capital was not inherited or gifted. It came from relentless, consistent, hands-on, entrepreneurial grinding. First, he hustled with the Washington Post, paper route, which became a miniature empire. For Buffett, the paper route was much more than a simple job. It was a small, integrated logistics and distribution business. Working for the Washington Post, he was responsible for more than just tossing papers. He managed younger carriers, handled collections from customers, solved delivery and logistics issues, and banked the retained profits. This experience taught him the intricacies of margin management and the value of routine, as well as reliable cash flow. By age 15, through this venture and other small activities, he had accumulated over $2,000, a substantial fortune in 1945, equivalent to over $34,000 in today's money. This capital demonstrated the power of compounding savings and consistent effort. Then he managed a pinball machine empire. In perhaps the best early example of his business acumen, Buffett and a friend bought a used pinball machine for just $25. They negotiated a profit-sharing arrangement to place it in a local barber shop, splitting the coins collected from its use. Based on the swift cash flow, they quickly bought more machines. Within a year, they owned several machines placed in multiple strategic locations. This taught him a crucial, enduring lesson that underpins much of his later success. Invest in simple, cash-generating assets that require minimal oversight and provide high returns on capital. This early hustle generated his seed money, but it were his academic years that gave him the foundational intellectual edge. While at Columbia Business School, the course of Buffett's life was irrevocably altered when he met his intellectual mentor, Benjamin Graham. He taught Buffett the core principle of value investing, buying a stock when its market price was significantly less than the true, underlying intrinsic value of the business. Graham called this key difference the margin of safety, the cushion that protected the investor from inaccurate analysis. This was fundamentally an approach rooted in deep accounting and financial analysis, treating a stock not as a piece of paper, but as a proportional claim on a real-world business. When Buffett returned to Omaha, he was a small-time, disciplined operator, and the first major, aggressive step toward his first million was something highly unusual for a budding investor: the formation of a private investment vehicle, the Buffett Partnership. In 1956, at the ambitious age of 25, Buffett founded the Buffett Partnership with a handful of family and friends. What is often untold about this partnership is both its radical fee structure and, more importantly, the aggressive unconventional strategy it employed. While most investment firms of the era took a flat 2% management fee regardless of performance, plus 20% of the profits, Buffett adopted a structure that was revolutionary in its alignment of incentives. He took no management fee. He only earned money after his partners had received a 6% annual return on their capital, which was referred to as the hurdle rate. After that, he kept a massive 25% of all remaining profits. This arrangement perfectly aligned his fortunes with his partners. If the partners made exceptional returns, Buffett became rich. If they didn't, he earned nothing. But the real secret sauce that generated the partnership's explosive early returns was the three-pronged approach he used, with the third prong being the most critical for his first million. First, he used a pure Graham and Dodd approach. This was the most straightforward, purely analytical approach. Buffett would assess companies' general undervaluation, looking for classic cigar butt stocks, companies trading for less than their net working capital. He was essentially buying companies so cheap they were trading for less than the cash, inventory, and receivables on their books. He'd buy them, patiently wait for the market to realize its glaring mistake and reprice the stock, and then sell. This strategy was simple, but often slow, requiring great patience. Buffett also mastered a risk-free arbitrage approach. This often involved buying shares of one company immediately after it announced a definitive merger with another. For example, if Company A agreed to buy Company B for $50 per share, but Company B's stock was lagging and trading at $47, Buffett would buy Company B and wait for the deal to officially close, which was a certainty barring major regulatory issues, confidently pocketing the $3 difference. This was low risk that requires meticulous research, patience, and a deep understanding of corporate finance. The third approach he used was corporate activism. This is the least known, most aggressive, and most critical element that drove him to his first million. Buffett later called these workout situations. In these cases, Buffett would not just buy a stock, he would buy a huge concentrated stake in a highly undervalued, poorly managed company, often achieving a controlling interest to influence the board. He would then use his leverage and power to actively intervene. This intervention could involve forcing management to sell assets, liquidate the company, or drastically change policies to unlock the true value that the current, inert management had failed to realize. This approach was hostile, messy, and incredibly lucrative. This hands-on activist approach is where he first earned the moniker, a charming corporate predator. By 1960, the partnership was gaining significant momentum, but it were four specific workout situations that provided the rocket fuel for his personal fortune, proving the effectiveness of his hands-on, aggressive strategy. This is the untold core of the story of his first million. First, the Sanborn Map Company. This was a quiet, almost forgotten business that made detailed fire insurance maps for cities, a utility business whose relevance was dwindling. But Buffett noticed something incredible hidden on the balance sheet. The company held a huge forgotten portfolio of stocks and bonds worth approximately $65 per share, while the company's operating stock was only trading for $45. The market was entirely ignoring the massive investment portfolio. Buffett started buying aggressively. Crucially, he contacted other large shareholders and convinced them that the company's operating business was essentially worthless. But the hidden financial assets were massive. He formed an investor group, quietly took a controlling position on the board, and then forced the board to distribute the entire investment portfolio to shareholders, essentially dissolving the hidden value and realizing a massive instant profit, a 50% profit in under 3 years. This was an elegant liquidation of value through corporate control. Then Dempster Mill Manufacturing came around, and with it, the turnaround of a CEO. This company made farm equipment, primarily windmills and water pumps. It was a dying, obsolete business in rural Nebraska. The company was incredibly cheap based on its assets, but it was being slowly bled dry by incompetent management and excessive costs. Buffett didn't just buy the stock and waited. He exercised his control and installed his own friend, Harry Bottle, as the CEO. Bottle's mandate was simple and brutal: liquidation of all non-essential inventory, fire redundant employees, and slash every non-essential cost. Within a year, Bottle had turned the operational cash situation around, successfully extracting the cash trapped within the business and realizing a massive profit for the partnership. This taught Buffett the ultimate power of operational control to fix a deep value investment and the importance of having the right management team in place. Another company he invested in was Hochschild Cones. This was a department store in Baltimore, a case of classic deep value investing mixed with market inefficiency. After Buffett bought his stake, the stock price languished for several years, confirming the market's indifference. The untold lesson here wasn't the initial purchase, but the timing and method of the exit. After a period of inaction, Buffett saw a strategic window to aggressively negotiate a deal to sell the entire stake back to the company's family ownership at a favorable private price. The partnership exited the position entirely, securing a major capital gain. This showed his willingness to bypass the slow public market entirely and aggressively negotiate a private, favorable settlement to lock in a profit. And lastly, Berkshire Hathaway. Everyone knows this name, but few know its origin was one of Buffett's earliest personal mistakes and, ultimately, his most profitable workout situation. Berkshire Hathaway was a failing New England textile mill. Buffett began buying because the company was performing corporate buybacks. The management was slowly purchasing stock from shareholders below its intrinsic value. Buffett, using his arbitrage skill, saw a quick, easy profit by selling his stake back to them. However, a personal slight changed everything. Management once offered him a specific high price to buy out his stock, but then reneged on the deal, offering a slightly lower price. Buffett was furious. He considered it a personal insult. So, he began to buy even more aggressively, taking control of the entire company in 1965. He fired the management. But the real genius was using the reliable, though dwindling cash flow from the dying mill to begin buying insurance companies. These insurance operations generated float, money he held from premiums that he could invest for free before claims had to be paid. This was how Berkshire became his permanent, personal, and infinitely scalable investment vehicle. By the end of 1964, the Buffett partnership's total assets had exceeded $12 million. This meant that Buffett's 25% stake in the profits, combined with his initial personal investments, had easily pushed his personal net worth past the crucial $1 million mark. He was 34 years old. The untold story is not a neat, clean, conservative narrative of simple, passive investing. It is the story of a ruthless, calculated operator who used every analytical and tactical tool in his toolkit. First, active control over passive buying. He didn't just buy stocks, he bought companies and then exercised his shareholder control. The million was built on the back of active corporate restructuring, forced liquidation, and management intervention. He also forced the issue. He didn't rely on the market's efficiency, he forced the issue. When the public market refused to price a stock correctly, like Sanborn Maps, he'd take control and force the intrinsic value out. Lastly, Buffett was always prioritizing cash flow. From the pinball machine to the textile mill, every business was viewed as a strategic source of operational cash. In 1969, Buffett did something shocking that confirmed his non-passive methodology. He closed the partnership entirely. He told his partners the market had become too expensive. He couldn't find enough workout situations to justify their high expectations and the substantial fees he charged for his performance. He returned their capital and retired from the partnership business to focus entirely on Berkshire Hathaway, taking the lessons learned from those scrappy, aggressive early deals and applying them to a new permanent vehicle that could house his vast sums of capital. And that is the real foundation. $1 million built not on folksy abstract advice, but on a decade of aggressive, hands-on, no-holds-barred corporate warfare, setting the stage for the investment legend we know today. Buffett's first million wasn't just an accumulation of money, it was an accumulation of wisdom. The willingness to get his hands dirty, to be the majority shareholder, and to challenge bad management. The question I have for you is this: considering the lessons from his early success, which of these untold strategies, the aggressive workout situation, the risk-free arbitrage, or the simple search for deeply undervalued assets, do you think is still most relevant and accessible for investors today? So, let me know your biggest takeaway in the comments below, and I'll see you in the next video.